Brigid Taylor, and this is Currency Wars. Domestic data and announcements were the main focus this week as global markets started to recover from recent sell-offs as earnings season kicked off favourably. Meanwhile at home, South Africa's CPI fell back within the SARB's target band to 5.9%. This suggests that the South African Reserve Bank is likely to be comfortable in holding rates steady at the coming November MPC. Additionally, taking into account that the greater short-term stability found by the Rand and growing evidence of both a domestic and global growth slowdown. Meanwhile, the main focus this week was the medium-term budget statement. Whilst initially the market took the comments made by Minister Nene as positive, a closer analysis is skewed more slightly to the negative. Real risks do exist in the terms of the projected narrowing of the deficit in the next 1 to 2 years, as sluggishness in the economic growth is expected to persist well beyond 2014. As such, we continue to see pressure on South Africa's aggregate rating over the medium term. There's still room for downgrades from Moody's and Fitch, who currently hold negative outlooks, before the much larger step towards junk ratings become a possibility. Minister Nene stated that the fiscal consolidation could no longer be postponed, and in turn put forward measures to lower the expenditure ceiling by some 25 billion rand over the next 2 years. In essence, this is only a mild trimming and leaves much to be desired should the government's growth forecasts continue to undershoot expectations, as they have already proved to do in the past. There is uncertainty for the market on the government's intention when it comes to the tax adjustments. The wording in the mini-budget was somewhat vague around these adjustments and will only be fully revealed in the main budget in February, with hints of a stealth tax increase to make up the projected increased revenues. When 30 billion rand has been lost to corruption, it begs the question, how will government manage these losses when faced with the desperate need for fiscal consolidation? Now that we know the lay of the land, let's welcome our guests today, Andre Eerenstein from RMB and Andre Cilliers from TreasuryOne. Welcome, guys. Right, so it's all been about South Africa. We had CPI yesterday, came in below the target band, Rand's behaving itself, so looks like MPC is probably going to be a flat decision again. What's your view in terms of our upcoming MPC?
Yeah, certainly. When you look at the data that we've seen, you look at the global growth environment, and inflation is now below the target. So certainly there's room for them to stay on hold. It doesn't get around the fact that we do need to normalize policy at some point in time, but I think the SARB has time on their hands.
Yeah, and the growth trajectory also talks to that. I mean, at the moment, with the consumer under so much pressure, with the Rand behaving itself, how do you really justify a rate hike in this kind of environment?
Well, 2 ways of normalizing policy. That's inflation coming down and the gap between interest rates and inflation becoming bigger, or increasing interest rates. And it looks like the first one of lower inflation is coming in. I think we can look towards another lowering of the fuel price at the end of this month. That also bodes well.
Thank God, and I think that a lot of your clients will be certainly alleviated, a lot of pain will be alleviated from that with regards to the supply chain. So let's talk about medium-term budget yesterday. We had the medium-term budget. I think there was a lot of hype pre the budget. Obviously, Minister Nene under a lot of pressure with the announcement. Sounded really positive, but if we really dig deep and we start looking at the cracks of the matter, so the fundamentals that we've spoken about on this show ad nauseum, they reared their heads and there's no real solution. I mean, you and I had this conversation offset just saying, how are we going to do these things that you're proposing? So let's go through those and let's talk about what was discussed in the budget, and for you specifically, where are the risks?
The risk really lies in the how to do whatever he said. I mean, he's speaking about increasing revenue over the next 2-3 fiscal years, but he doesn't really say to me how he's going to raise it. With an economy that's in decline and growth that looks benign, we can't look towards income from that end. And the only other way then would be to tax people, and I don't think that's going to be of any benefit.
Well, I think that was something that a lot of people post the statement were very cautious about. I mean, if we look at commentary that came out was, saying the tax word was used, but very glibly and very quickly and almost shoved under the carpet, and let's not worry about it until February next year. But I mean, it is something that we have to consider.
Well, I think when you look at any sort of plan, the key to success is implementation.
Sure.
And I think when you look at the tax burden, we already, the tax burden is already very, very high on the populace. Mm-hmm. And if you talk about VAT increases, that doesn't really, it's not sustainable in the long run.
But VAT increases are unlikely because it's going to impact everybody,
Sure.
right? So
But
what ends up happening is that the minority of the populace will be hit by taxation, but it's already been hit by taxation, and
Sure,
the
but that-
consumers under pressure.
But
so,
then
you
that
know.
then takes away from consumption, that
Sure.
then fuels the downward trajectory of growth, which then has an impact on future revenue, which, so you can kind of see it's a vicious loop. So one must be very careful when you look at it. There are possibly other avenues which they need to look at, but ultimately just taxing a society is not really, particularly in a low growth environment, is not a sustainable solution.
Without a doubt. I mean, the other thing that concerns me as well is we're looking at ratings agencies, and I think that was one of the key drivers of the sentiment around the statement. So if we look at where we sit currently, I mean, we're on negative watch. Come December, they're going to relook at us and make statements around where South Africa sits. We've had the IMF outlook with regards to the global outlook, and then obviously with specifically highlighting structural imbalances in South Africa. With regards to that, however, the major focus will be around managing the current account deficit, the budget deficit, and how do we create some form of funding that allows that to narrow. Do you think that that's sustainable, or do you think that we're at a risk based on the fact that a lot of the suggestions that were made, what is the follow-through?
Well, I think the follow-through is it's what are going to keep the rating agencies at bay. For now, I think for December, we can expect them to keep us where we are.
Okay.
Looking towards February, we'll have to see what comes out in the budget then, and what's the actual numbers, and the way forward, and the actual steps being taken to curb these increasing deficits that we're speaking about.
But that's the
If
key.
that does not happen,
That's the key. And that's
then
the thing.
we've
We've got a
problem.
6-month window now. So we really are in a position where we've got to put taki to toe, and we have to make it happen. Because if we don't, there's going to be fallout, which obviously it results in the downgrade of the ratings. But if we look at the currency, so let's go back to the currency and talk about, even though we've seen all of this negative data, and we've talked about this before, is that the fundamental underlying issues still remain. However, the Rand's trading 11. So, you know, this is kind of the conundrum that you find yourself in as somebody that's an investor or somebody that has to hedge themselves. You know all of this bad news. And we all know at some point the chickens are going to come home to roost and it's going to come and bite us. However, for now, we're living in la la land.
No, sure, but I think when you look at our weak fundamentals have been there for the last 3-4 years. You know, at the trajectory on the current account deficit's been there, growth has been there, inflation trajectory has been there. Yeah, it's just the fact that you've got so much liquidity that's around, and a rising tide rises all ships. You know, and that's the key point. We've had a lot of portfolio flows into the country, and that's been supportive of it, and that's why the Rand is here. You know, when we get direction out of the Fed, I think that's where things are going to be very, very, very careful, because when we get trajectory out of the Fed, the market's going to move very quickly, and policy, as we know, takes a long time to implement, and it takes a long time to gain traction. So if there's an argument to raise rates in November, it's essentially that. You know, we have to normalize rates. We need to make sure that we're ahead of the curve. And you know, despite the fact that the economy is weak, despite the fact that inflation's low, you know, we're going to raise rates. It doesn't make, you know, it's not consistent from what's been coming out of government
So
markets.
what you're saying basically
we're
is
in a
that
new era.
The currency itself isn't speaking to what's happening fundamentally. So currencies purely are as a function of flows, looking for opportunity with regards to yield, etc. Specifically right now it's about yield. So because of that, the currency is not really a great indicator of the underlying fundamentals in the country. So if you could make a comment around your views for the remainder of the year and where you think, you know, the massive risks lie that need to be addressed right now, what would that be in terms of the number one key factor for you?
Number one key factor for me would be to address current account deficits, budget deficits, and debt as a percentage of GDP.
And how would
That
you
would
do
be-
that though? If
Well,
you
how
were
would-
a
if
government official?
if I was the Minister of Finance, then, and I was if I was the government, I would certainly be looking to addressing labour issues that brings instability into certain sectors. And I would actually be looking at some tax breaks for people that wants to do fixed direct investment into our country,
So
where we
creating
can
less barriers
create
to
opportunity
entry.
for manufacturing.
Agreed.
That's what I would do. I would create tax breaks for those people. Initially, it might look like you actually getting less money, but eventually you're actually increasing your
long-term
income.
gain. Exactly.
And that's what we need to gain.
And you, Andre, what would you think?
No, I think it's more or less the same lines. I think when we look at our current account deficit,
Yeah.
there are two ways to solve it. You either decrease imports or you increase exports. So you create incentive. If you look at what we import essentially energy and capital goods. You know, these are things that we need in order to manufacture. So I don't think there's a lot of scope in terms of imports. Where we do need to address the issues are on exports, and that means supporting small businesses. It means supporting manufacturing. It means going further down the value chain, not
And
only...
especially if the rand's going to weaken, because at some point the Fed is going to have to hike rates, and we're probably going to see a correction in terms of the currency, or certainly in terms of foreign inflows. So if that's the case, and you're building that type of trajectory in terms of your export sector, then that speaks to maximizing that type of move.
Sure, no, I completely agree with you, but you can't build a business on the trajectory of an exchange
Sure.
rate.
No,
You've got, you know, as a business owner, you have no influence over that.
No, sure.
You know, you've got to look at labor reforms. You've got to look at how can you hire more people? How can you become more efficient? What are the barriers to entry for that? You know, that's really the focus that needs to be done in order to incentivize people to start businesses, become more entrepreneurial, and then you'll kind of see manufacturing increase, and that's the route to solving the current account problem, because that's also going to solve the growth problem.
And it's got longevity and a bit of sustainability. I'm going to ask you, just in terms of people that are really interested about the real levels of the currency, as much as we know the foreign flows are impacting that, let's talk about the ranges that we can expect. I think we've called it pretty well over the last couple of weeks. So where to from here? Are we going to break that 11 area, or do we think we're going to continue to bounce off it? I'm going to start with you, Andre.
Yeah, I think broadly the range still maintains. I can't see a lot of substantial rand strength, so I'm going to call it over the next week probably 90 to 11.10.
Okay, that's fair. That's fair. And you, Andre, do you want to and also throw in a euro rand for us?
I'm going to throw in the euro rand. I'm going to start off there. We've got to really clearly watch. We're at the bottom end at the moment of our last ranges, but if we get down to the 1380, 1378. We could be in for a bit of a surprise down even lower.
Okay.
But I don't think that will happen, so I'm going to call 1385 to 1410 on the crossroads. Pound, I'm going to call 1760 to 1785. And on the dollar rand, I'm going to stick to 1090, 1115.
Okay, so your dollar rand view is pretty much the same for the week, looking at a potential strengthening below that 11 level to about 1090. Not much weaker than 1115, 1110, according to Andre and Andre. And then on your euro, watch that 1385 level. It is quite important, potentially could weaken back up to the 14. You're welcome to send your questions or your comments to @CNBC Africa #CurrencyWars410, or to myself at Brigid R. Taylor for your personal responses to the FX markets. Until next week, good luck in the trenches.